single time my stop loss would get hit just to see it go my way. That was until I discovered the concept of liquidity. If you want to learn to trade like this and catch real moves, then keep watching. To fill their orders, large players like institutions need to have enough people buying or selling to them. Because remember, for every buyer, there must be an equal seller, and for every seller, there must be an equal buyer. So very often, price will seek out liquidity in the form of stop losses. Long positions that get stopped out turn into market sell orders, which can then fill positions of other buyers, and vice versa. Knowing where liquidity is hiding is fundamental to making good trades, and liquidity is a magnet for price action. We call this concept a draw on liquidity. The main idea is to frame the bias, where price is likely to move, and then take trades in that direction. The first area where liquidity can be resting is at support and resistance levels. Commonly, these are equal lows or equal highs. Another area where liquidity is likely to be resting is trend lines. We can assume that some traders might have their stop losses around this area. And most importantly, swing points are an area of engineered liquidity, ready to be hunted. All of these areas are where traders would likely have placed their stop losses based on some form of technical analysis. When liquidity has been tapped, a big move in the opposite direction may occur. We can assume that larger players have filled their position, and this is why the market feels like it's always targeting you. Here's how you can use it to your advantage. When we know that the overall market is bullish, we want to see a retracement down, with liquidity resting higher. This can be in the form of trendline liquidity. You want to see price take out liquidity down first, with confluence of another level like a fair value gap. You can look to long the fair value gap, targeting the liquidity above. Up until now, we've looked at highs and lows as our points of interest. But there's actually another thing that we have to look at in order to truly understand this concept of liquidity. Very often, you will notice how price reverses from these highs, and when they do, they usually are reaching for another objective. And that objective is the fair value gap. All of these inefficiencies in the price chart will get filled either partially or completely before a reversal to the other side. We call this internal range liquidity, and external range liquidity is defined by highs and lows. When external range liquidity is taken, a fair value